All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world. Happy Friday, everybody. Today's November 21st, 2025. How about that reversal yesterday, huh? We'll get to that in just a second. But the top story this morning is the Fed. The parade of jawboning has begun. Out of nowhere, we've got scheduled on the docket today five Federal Reserve governors will be coming out and speaking to us, trying to move markets with their words. And of course, whenever they do that, they're almost always trying to move markets higher. Isn't it funny how it works that way? We must protect the AI bubble at all costs. Circle the wagons. Don't listen to randos, rate cuts, Zerp and Burr, whatever it takes. Sacrifice everyone at the altar of Jensen's revenue pump. Well, we had a couple of them so far. We had Fed Governor Williams spoke earlier this morning. He was saying, basically calling for a December rate cut. That moved markets quite a bit here. We saw the markets move higher when Williams said that. We saw the odds of a rate cut in December went from about 30% 2 days ago, and they shot up this morning to over 70%. So a lot of people were saying the Fed rate cut wouldn't happen in December, even though the Fed never said that. A lot of people were just kind of extrapolating that based on, some comments about uncertain data. Shout out to my friend Joe Brown on Heresy Financial in his market wrap-up live stream yesterday. He mentioned that the Fed never said they weren't cutting and that other people were saying that and kind of projecting it. And the Fed came out today, and at least Williams said they are cutting. Now, we had Susan Collins, another Fed governor, is talking as we speak right now. She kind of hinted that she's comfortable where policy is at, somewhat taking away from that December rate cut likelihood. We got three more governors are going to talk today. I don't know what they're going to say, but this is classic jawboning, guys. When the Fed comes out and they start talking, trying to move the markets without having to do policy. It's not supposed to work that way. Hundreds of billions of dollars is not supposed to flow based on the verbal whims of a bunch of unelected bureaucrats, but that is the market we have. So we got to pay attention to that one. Also, we have got a total mess on our hands in Japan. Where do we start with everything going on in Japan? Now, first of all, I saw a couple of people comment on this on the live stream yesterday, and then in my video yesterday about the market calling bullshit on NVIDIA's earnings. Check that one out in the feed, by the way. A lot of people are saying Japan may be playing a role here, and I'm not sure that there's a very good chance that's correct. I can't rule it out. I'd actually say it's very likely. So what do we have going on this morning? First of all, Prime Minister Sanai Takaichi's finance minister is out there saying, here come the stimmies, 135 billion of stimmies. And that may not seem like a lot of money to us here in the States where we throw around trillions like a rap video. But in Japan, considering the size of their GDP, that's a huge amount of stimulus. It's actually the biggest stimulus since the end of the COVID disruption. It's even bigger than the stimulus following the Tohoku earthquake in 2011 that leveled the Fukushima plant. You'd think I'd be able to remember that name off the top of my head. So a lot of stimmies coming out of Japan. Very dovish move. At the same time, you've got the finance minister came out last night, right around 10 p.m. Eastern time, and basically called for an intervention in Forex market, a yen-intervention, if you will. And we saw the yen move on a dime when he said that. We saw the Japanese 10-year government bond yield drop on a dime as soon as they said that. So even the finance ministry in Japan getting in on the jawboning action this morning, talking about how, we're gonna intervene in Forex markets. Also, he mentioned something about the U.S. Treasury in his comments, suggesting they won't be selling their bonds in order to raise the dollars to defend their currency. They might be using currency swaps. They didn't say that specifically, but they hinted at it, which would mean that the U.S. Treasury is now propping up the currency in Argentina and in Japan. All right. That's not good for us, guys, because that increases the number of dollars in circulation. In other words, it's inflationary, even though they say it's balance sheet neutral. And last but not least, we've got all that dovish stuff going on. And then in a totally different direction, you've got Kazuo Ueda, the chief of the Bank of Japan, their central bank. He's their Jerome Powell. He came out last night suggesting that a December rate hike is now more likely. So the Japanese may be raising borrowing costs at the central bank, while the finance ministry is doing FX swaps and interventions and stimmies to try to stimulate the economy. Central banks and finance ministries pulling in opposite directions, probably not good. It's like parents fighting in front of their children. Average people caught in the middle. Yikes. And again, with all the movement in tech stocks we've seen recently and this brutal sell-off in Bitcoin, that is continuing this morning. Maybe Japan playing an outsized role in that. Can't be ruled out. Speaking of the Bitcoin sell-off, that one went pretty bad last night. We went as low as 81,000 overnight when Fed Governor Williams came out and talked about the December rate cut and increasing the odds of that. We did see Bitcoin rally a couple of thousand, seems to be turning back down south now. We've also got a big sell-off going on in gold and silver this morning, right around options expiration. My friend Bob Coleman over at Idaho Armored Vaults has been pointing out some very suspicious activity in silver markets. And when Bob Coleman does that, it's worth paying attention to, because Bob Coleman is not a Chicken Little who goes on YouTube and cries wolf about silver manipulation day in and day out. He's actually very critical of that narrative. And what he sees, it's a little spooky. We'll talk about that one as well. Now we got to talk about yesterday's big reversal. You know, I had a lot of people in the comments were saying that, yeah, nice call, Jack, you called that. And yeah, I did call that, and it was kind of non-committal the way I called it, but I did call for it. I mentioned the reversal that we saw after Oracle and Palantir earnings, and that Nvidia may be the same thing. But there's a couple of other people who made that call with a lot more enthusiasm and before I did. I want to give them a little bit of credit here. First of all, Kirian Van Hest, Deso Games on Twitter. He's been a guest on the channel before. He called that as soon as those earnings got reported. Good call, Kirian. Kalani Omawi from the Macro Edge group, he was calling that yesterday. Big move, nailed that one. And our very own magnanimous melon head here, Mr. Jason Bennett, nailed this one yesterday in a super chat. He said, I think Jack's right. Jensen was ramping up retail enthusiasm for exit liquidity. We're going to see red today. Nice call, Jason. You clairvoyant melon head, you. Good job, sir. We ended up getting that big reversal. It was pretty stunning. 1,100 point intraday swing in the NASDAQ yesterday, the biggest since April. A lot of articles I read this morning mentioned the blah, blah, blah since April in their language. April was all the ructions in the bond market caused by Liberation Day and the tariffs. So this is a pretty big deal, this sell-off that's going on, even though it's only been like 5% and the market's rallying right now. And we're probably going to see a little bit of a relief rally. Still, can't ignore these comparisons to April here. And now debt worries are front and center in the AI bubble. There was a lot of talk about CoreWeave and Oracle and their inability to pay again this morning. Also going on this morning, we've got another chip smuggling bust into China. You know, that thing that isn't happening again. 4 guys were arrested for smuggling chips into China by way of Malaysia. Interesting. Who's been calling that one for the last year and a half or so? Also, shout out to my friend Kakashi, who has been very adamant about the chip smuggling as well. That thing that ain't happening just happened again. Now we got to talk about the housing market today too, guys. More than half of U.S. home values are currently falling. Shout out to Johnny Bravo called that one yesterday in his video update. Pretty crazy. We'll talk about what cities, what regions are being hit the hardest. And let me know in the comments. Let's do like an unofficial verbal poll. I probably should have told my moderators to throw a poll up here, but let me know what you guys think. What do you think is the average age of a first-time home buyer in the United States right now? What do you think that is? Let's see some numbers in the comments. It'll be towards the middle of the show that we get to that one. I wonder what you guys think. Just throw a number out. We know it's hard on young people right now, but how hard is it? What is the average age of a first-time home buyer? And along those same lines, we've got another article saying 401k hardship withdrawals have more than doubled because it's the best economy ever, right? People are tapping into their retirement savings in order to live because they can't afford the cost of inflation. Shout out to Mike Green, who has been calling for a while that if we get a rise in unemployment or if cost of living stays where it's at, that we are going to see passive inflows into the market. In other words, people just passively investing in their 401ks every paycheck, that could turn to passive outflows in the market as more and more people tap into their 401ks. And we're seeing that now. On top of all that, we've got Amazon laying off thousands of engineers. See also that talking point about the passive inflows turning to passive outflows. Thousands of engineers are being laid off. Now, these are previously announced layoffs that Amazon had done about a month ago, but it turns out it's not the guys in the warehouse moving the packages, it's engineers. And that is something that Amanda Goodall called last week when she came on the channel, aka the jobs chick on Twitter. She talked about layoffs in engineering and how it's not AI, it's outsourcing, and it's H-1B visas. So shout out to Amanda, very good call there. We've got President Trump is rolling back tariffs this morning on Brazilian beef and coffee. Interesting story there, because those are the tariffs that he put on supposedly in retaliation for the prosecution of former President Bolsonaro. He's getting nothing for it. They didn't stop prosecuting the guy. He's just rolling back the tariffs. That means those statewide elections a few weeks ago have really spooked Republicans. They're now taking this cost of living thing seriously, even though their answer has been stupid shit like 50-year mortgages and stimulus payments. But I digress. Rolling back tariffs on beef and coffee here, probably going to upset the cattle ranchers a little bit more. And it just goes to show you Washington is taking this affordability crisis seriously. And last but not least, we got this article in Bloomberg this morning about private credit defaults expected to rise sharply in 2026. And apparently private credit now accounts for 11% of U.S. GDP. What? Holy crap. That is a recession in a box right there. We got a lot to talk about this morning. Why don't we shrink my big melon of a head and let's see what's going on in the world of finance today. Don't forget that like button. And you new guys, hit that subscribe button right next to it so you can come back tomorrow and have your coffee with the melon heads. By the way, shout out to all you new melon heads who have joined the channel over the last couple of days. Welcome, and may the odds be ever in your favor. Hey, here's one we haven't looked at in a while. The CNN Fear Greed Index. Extreme fear. We are sitting down here at 8. That's about as low as I have ever seen this thing. And this is just saying, guys, that the market is ripe for a rally here. We have seen a pretty sizable sell-off. I don't know how big of a rally. Is it going to be a dead cat bouncer onward and upward to new highs? All I'm saying is when extreme fear, when we go this deep into fear territory, it usually signals a short-term bottom. Just want to show on the timeline here of the CNN Fear Greed Index. Here we are right now. We went as low as 7 this morning. The last time we were anywhere like this was April 9th, right before Taco Tuesday or whatever day of the week it was, right before the U.S. balked at the tariffs and we started that endless cycle of 30-day delays and negotiations and everything. The bond market wins every time. That was April 8th that we bottomed. On April 9th was the Taco. So again, when you get to a bottom like this, or when you get this deep into extreme fear territory, it usually signals a reversal. How big is anybody's guess? And right now we're getting something of a reversal here. Maybe a dead cat, maybe not. 31 points higher for the S&P 500, 0.47% to the upside. Most of that coming in these last few minutes here. This is when Fed Governor Williams came out and called for that December rate cut, and the market really liked that one. The Dow is up by 231 points, also about 0.5% higher. Most of that coming in the immediate aftermath of Governor Williams' comments, and we've since given back some of those gains. And the NASDAQ is up 0.38%. Interesting, the NASDAQ is lagging the other indexes here, 90 points higher. Most of the gains, again, coming after the Fed parade of jawbones began. The U.S. dollar is a little bit stronger here, 100.29. That's higher by 6 basis points. Maybe that talk of Japanese currency intervention overnight contributed to this one. And let's see, when was this? About 7:30 is when we saw this start to head lower. That was when Williams started talking here. So slightly stronger dollar, although it could be a little bit stronger. Governor Williams took a little bit out of that. Looking over at the bond market this morning, we've got lower yields nearly across the board. 30-year yield, 4.705. That's lower, almost 3 basis points. The 10 years at 4.059. That is 4.5 points to the downside. The 2-year yield is at 3.505, off by 5 points this morning. Big move in the 2-year. And the 1 month is at 3.949. That's actually higher by 1 point, even though the odds of the December rate cut have gone up. We've got the 1-year yield is up by a point. Okay, that's interesting. I guess it's an older quote. We'll have to keep an eye on that one. And looking over at the commodities board, wow, sharp reversal in gold. Metals were lower earlier this morning, and I guess that dovish comment from Williams moved the gold markets. Now, spot gold is still down by a couple of bucks here, $3.50, sitting at $4,073. Now, we've got December gold futures on the COMEX are higher by 12 bucks here, or 4,071. But these were both deep in the red earlier this morning, recovering on those dovish Fed comments. Silver, on the other hand, is still deep in the red this morning, although it was much deeper in the red earlier this morning. A bludgeoning for my favorite of the shinies this morning, $49.69, lower by 96 cents or 1.9%. December COMEX futures not doing any better here, 49.34, off by 96 cents or 1.9%. But you know what? I still like the shiny. Copper is higher by 0.1%. Platinum is pretty much unchanged here. Palladium up just a tick, a little less than 0.1%. Crude oil is lower by $1 this morning, or 1.83% lower, 57.93 for January WTI futures. Concerns about energy supply gluts continue to permeate the market here, guys. Keep an eye on those oil majors. I think that you might see a buying opportunity in the not too distant future for those oil majors. I don't think oil is going to stay in the high 50s very long here. Honestly, I think we're heading towards the 30s probably early next year. All right, back on the metals. I want to send a shout out to Bob Coleman. He posted a couple of good ones earlier this week. This one just a few hours ago. Gold and silver alert. I posted a trading pattern that has existed since June, whereby the buying pressure and gamma squeezes from the options market in SLV have been quelled by increases in short selling, in parentheses here, naked short selling via reg show. Bob is calling out failures to deliver here. In other words, market makers are going naked short SLV to avoid SLV share creation if in the money calls were exercised. So what usually happens if people go long SLV and SLV rips higher, you typically get new shares of SLV are created in order to bring the price down. And then when those new shares are created, they have to go buy the physical silver in the market. And that's how the ETFs can move markets. What Bob is saying here is that they are naked shorting SLV, which means they're not creating those new shares and they're not going out and buying the silver. They're just absorbing the buying pressure. They're just absorbing the liquidity. In other words, they are manipulating silver prices lower. Bob Coleman is a huge critic of silver price manipulation narratives. All right. Bob is a realist, and he's not big on the hyperbole. So when you see Bob Coleman saying this, that should mean something to you. That means there really is something that smells going on in silver markets. I'm going to talk to Bob when we're done here, see if we can schedule him to come on the channel maybe early next week to talk about this. This is big, I think, guys. Pay attention to this. This share creation would have forced authorized participants to deliver more physical silver to the trust. In other words, the ETF is just absorbing the buying without moving the price. And Bob also called this one precious metals industry alert. With rising general market volatility, starting to see financing and carrying costs rise within the precious metal industry. Banks will tighten the belt to control collateralized loan risk and widening spreads. Bids on gold and silver products are falling hard at the moment. Nearly everything at a discount to spot. Offer prices, premiums on coins and bars have collapsed from 3 weeks ago. So look, guys, it just means the shiny is getting cheaper, both in terms of price and premium. So if you got some metal on your shopping list, well, keep your eyes open for opportunities. Thank you, Bob, for the excellent commentary, sir. All right, let's talk about Bitcoin here. Rough night for Bitcoin. We went down sharply here. These are daily candles. You can see crypto winter is accelerating to the downside. Now let's change these candles to hourly here, and you can kind of see a little bit better. We went way here. Let's zoom in here. We were way down last night. We bottomed out around 7:30 this morning. We went as low as 80,500. We were threatening to go into the 70s here. And then Fed Governor Williams comes out, jawbones the market higher, talking about December rate cuts, and Bitcoin rallied almost 5,000 on that news. Since then, give it up a little bit of that. But guys, Bitcoin is not looking good here. $83,659, off a couple grand from yesterday. And I have noticed an eerie, at least directional correlation between Bitcoin and NVIDIA and the tech stocks here. So keep an eye on Bitcoin. When you see a big candle forming in the minutes or the hourly candles on Bitcoin, it usually means something is about to follow in tech. Let's just talk a little bit about this. Bitcoin heading for the worst month since the crypto collapse of 2022. And there's one thing I want to point out here. Bitcoin has now shed a quarter of its value in November, the most for a single month since June 2022, according to data compiled by Bloomberg. The implosion of Do Kwon's Terra USD stablecoin project in May of that year sparked a daisy chain of corporate failures that culminated in the downfall of Sam Bankman-Fried's FTX exchange. Guys, we have not yet seen any implosions in crypto. Crypto is way down here. What are we, like 30, 35% off our highs right now? Major bear market for Bitcoin. And yet there has been no Terra Luna collapse. There has been no Do Kwon, no Gemini or Genesis, all the other companies that froze withdrawals, certainly no FTX. That hasn't even started yet, which means Bitcoin has not seen a bottom. Even if the Fed comes in and jawbones it higher today, guys, crypto winter, it's early yet. Don't expect a bottom for months. And now here is the schedule of jawboning muckety mucks this morning. You see 7:30, we had Fed Williams at 8:30. Barr started talking at 8:45. Jefferson at 9. We had Collins and Logan, 5 different Fed governors all coming out today. Oh, the market didn't rally on NVIDIA's earnings. Quick, get the Fed governors out to talk about rate cuts, juice that market higher, turn those machines back on. Mortimer and Randolph. Yikes, guys. Just a reminder, market's not supposed to function like this. This is not a free market. This is unelected bureaucrats moving markets because they control a money printer and therefore everybody wants to hear what they say. And here's one of the things that they said. New York Fed President Williams sees room for further adjustment to rates. In other words, a December rate cut is coming. I view monetary policy as being modestly restrictive, although somewhat less so than before our recent actions. In other words, interest rates are lower than they were before we cut them. Brilliant commentary from Williams. He said in remarks from a speech in Santiago, Chile, therefore, I still see room for further adjustment in the near term to the target range for the Fed funds rate to move the stance of policy closer to the range of neutral, thereby maintaining the balance between the achievement of our two goals. Long-winded thing for a long-winded sentence to say, we're going to cut in December, or according to me, we're going to cut in December. And look, this is the CME Fed Watch tool. Right now, the odds of a cut in December are 71%. Let's refresh this and see if it's moved. Come on, guys. Come on, little buddy. Well, we were 71% before my computer took a dump here. There we go. Okay, now 74%. You can see the odds are rising of that December rate cut, according to the CME's Fed Watch tool. As these jawboning muckety mucks continue to talk rate cuts, this was 30% just a few days ago. Now it looks increasingly likely that the Fed cuts in December. Oh, NVIDIA had one bad day. Quick. Cut rates, print money, juice inflation higher. Who cares what we do to Main Street? Just get Jensen's stock higher. Now let's talk about what's going on in Japan. What a mess over in Japan. Japan approves $135 billion stimulus to mitigate the inflation plan. There's Sanai Takaichi, the new prime minister over there. She is a dove. Japanese Prime Minister Sanai Takaichi's cabinet approved the latest round of extra spending since the pandemic. The largest round of extra spending since the pandemic, deploying funds to address the frustrations of voters in a package that may unsettle investors scrutinizing the nation's finances. Look, printing money and helicoptering it into the economy to fix inflation, economic illiteracy for 1,000, Alex, that's not how it works. That's how you make inflation worse. Did 2022 not happen? Was everybody asleep in 2022 when okay, I think preaching to the choir here. My viewers are smarter than that. You guys know that. Let's move on. The stimulus plan will feature 17.7 trillion yen or $112 billion in general account spending, the Cabinet Office said Friday, representing a clear jump from last year that will be reflected in an upcoming extra budget. The total package was valued at 21.3 trillion yen, with the bulk of the measures aimed at price relief. Spending money to relieve prices doesn't work. We've put together this package to protect livelihoods and particularly to respond quickly to the problem of inflation by making it worse, Takaichi said after the details of the measures were released. Now, this chart here is showing the size of Japanese stimulus. That blue chart is what was just proposed. Obviously not as big as the wacko moves that the world made during the vid, but you will notice bigger than the Tohoku earthquake and the global financial crisis. They're going to helicopter even more money than they did from the tsunami and the GFC. Takaichi is faced with the challenge of appealing to voters with large-scale measures to show she's doing something to address their frustrations, while at the same time holding bond vigilantes at bay by not letting the country's debt burden get out of hand. Yeah, right. That's a hard task to juggle with a minority government that's been severely weakened by recent national elections. And even as they're talking about stimmies, we've got yen intervention intervening in the Forex market. Japan says yen intervention an option in ramped up warning. This moved markets on a dime when they said this overnight. Japan issued its strongest warning yet over recent movements in the yen, with the nation's finance minister specifically mentioning intervention as an option, as she tried with only limited impact to stem falls in the currency. The government will take appropriate action against disorderly FX moves, including those driven by speculation as needed, in line with the approach set out in Japan-U.S. joint statement issued in September, said their finance minister. Why is it every time they're talking about, like, our policy is so batshit crazy that our currency is collapsing, they always blame speculators, right? Like all the way back to Nixon in 71. Remember when he closed the gold window in order to defend the dollar against the speculators? Yes, it's always the speculators, not our shitty policy, that causes the currencies to collapse. Okay, let's move on from that. Also note that they're talking about they're going to be in line with the approach set out in the Japan-U.S. joint statement issued in September. All right, since the Japan-U.S. finance minister's paper in September clearly included FX intervention, that's naturally something we can consider. In other words, they're going to use currency swaps. They're not going to sell their U.S. treasuries to raise the dollars in order to dump those dollars in the Forex market to prop up the yen. They're just going to do this outside of the markets, this magical thing where the U.S. Treasury creates dollars out of thin air, gives them to the Japanese in exchange for yen that they created out of thin air. Then the Japanese go dump those dollars in the Forex market. That's what they do. So increasing dollars in circulation in order to defend the Japanese currency, that goes nice with the increasing dollars in circulation in order to defend the Argentinian peso. Currency swaps, inflation, money printing, dovish monetary policy. It's everywhere. It's like 2022 never happened. Meanwhile, the Bank of Japan is pulling in the exact opposite direction. Bank of Japan signals a chance of December rate hike as the yen slides. There's Kazuo Ueda. This guy was supposed to be a hawk. He's been somewhat hawkish since taking over the Bank of Japan, but just barely. Well, he is holding true to his modestly hawkish roots this morning. Bank of Japan Governor Kazuo Ueda said he wanted just a bit more data on next year's wage growth direction and warned of the boost a weak yen could have on underlying inflation, issuing the strongest signal yet on the chance of a December rate hike. Ueda also told Parliament on Friday the central bank will discuss at upcoming policy meetings the feasibility and timing of a rate hike, a change in tone from previous remarks that the bank had no preset idea of the timing of the policy shift. The comments came as the yen slide to a 10-month low against the dollar raised pressure on Japanese policymakers to combat further declines in the currency that would inflate households' cost of living. Ueda said the BOJ must be mindful that the weak yen could affect underlying inflation, a key gauge it looks at in deciding how soon to raise rates by pushing up import costs and broader prices. Now, look, guys, the weak yen is because Takaichi is trying to print money, trying to do stimmies. And she's trying to do stimmies because inflation is so high. But the reason inflation is so high is because of the weak yen. This is a doom loop of stupidity. Ueda's trying to raise rates into this to try to slow it down, but he's pissing in the wind here. I don't know what to tell you, Kazuo. But look, the Japanese yen has weakened substantially, including since Takaichi was elected, going pretty much vertical over these last few weeks. Currently at 156.88. Here, this big red down. This was the August 5th, 2024 panic over the yen carry trade unwinding. You can see the yen is a lot weaker now. This is USD JPY. As this chart moves higher, that's the yen getting weaker. Let's set this to hourly candles here, guys. And you can see right around last night, where were we? Yep, right about 10 p.m. Eastern time last night. That is when the finance ministry mentioned the FX intervention. jawboning the yen just a little bit stronger as they did that. Remember, moving lower is strengthening the yen. So that threat of intervention did move markets a little bit. Now, it actually moved markets for borrowing costs a little bit more. This is the yield on the 10-year Japanese government bond. This has been going higher all year long. This is the big risk here. This is why people are freaking out over the yen carry trade right now, possibly contributing to the sell-off in tech stocks and Bitcoin. Now, these are daily candles we're looking at here. Here's the sudden drop that happened last night. You can see we went really high. We peaked at about 1.84% for Japan. That's very high by Japanese standards. But look at the hourly candles. And once again, it was 2200, 10 p.m. Eastern time last night when the finance ministry came out and said, we're going to intervene in the Forex markets if we have to. And that brought Japanese borrowing costs down. Shout out to my friends on Macro Edge who have been calling for a yen intervention for a couple of days now, saying any minute now. Well, last night, we at least verbally got it, although there's no evidence that they actually intervened with any kind of currency moves directly. Meanwhile, big tech's debt binge raises risk in race to create an AI world. Hey, Bloomberg, nobody wants your AI world. I know we keep talking about this, in an AI world and this and that, and Sam and Jensen are telling stories by the campfire. Nobody wants this shit. Okay, but I digress. Equity investors are growing increasingly concerned about the amount of leverage that big tech is taking on to build out its artificial intelligence infrastructure as the industry faces rising fears of a bubble. The enormous sums of major technology companies are spending on AI are nothing new, but the record pile of debt they're now raising to do it is. What's worrying stock traders is the trend represents a break from recent history when companies tap their huge cash piles to pay for their capital expenditures. The use of leverage and the circular nature of many of the financing deals introduces a level of risk that wasn't there before. Just a few months ago, AI spending was primarily coming from a few companies with strong balance sheets and robust growth and free cash flow. That has changed, and the tech industry's risk profile has along with it. The new dynamic was on display Thursday as tech stocks swung from way up after NVIDIA's strong earnings to way down as investors assessed how much capital will be required to finance an AI world compared with the profitability timelines of those investments. We've seen an expansion of the ecosystem to include companies with weaker balance sheets like Oracle and CoreWeave, more debt, and we've also seen more interlocking and circular revenue relationships, Chalet said. The interconnectivity between the players brings systemic risk. Wow, now we've got AI and systemic risk being used in the same sentence. That escalated quickly. Now let's check in with NVIDIA stock. The opening bell has rung. Oh, it's red. That's a shame. $178.42. Full disclosure, I am short NVIDIA, as you guys know by now. It seems the Fed pump was insufficient to keep the bubble inflated. That's too bad. Meanwhile, we've got another case of this thing that isn't happening again. Feds charge 4 in plot to export restricted NVIDIA chips to China and Hong Kong. How about that? 4 men have been indicted on federal criminal charges related to a plot to export NVIDIA chips worth millions of dollars to China and Hong Kong in violation of tight U.S. restrictions. Court documents show the chips are highly restricted from exports because of their use in AI and supercomputing applications, according to the indictment unsealed Thursday in U.S. District Court in Tampa, Florida. One of the defendants, Brian Curtis Raymond, a 46-year-old resident of Huntsville, Alabama, was identified last week as the chief technology officer of an artificial intelligence cloud company in Virginia that announced plans for a merger that would allow its stock to be publicly traded. Put a pin in that Brian Curtis Raymond guy. We may have more to say about him in the not-too-distant future. That's an interesting one. Raymond and 3 other defendants, all of whom were born in China or Hong Kong, are charged with conspiracy to violate the Export Control Reform Act of 2018 in connection with the export and attempted export of NVIDIA chips to end users in China and Hong Kong after first shipping the chips to Malaysia and Thailand. Shout out to Kakashi. Exactly what you said was happening, brother. Happening again. There it is. You got to love it. All right, let's talk housing, shall we, guys? There's some worrying headlines in housing here. Caught this one in Johnny Bravo's show last night. Housing alarm as half of all U.S. homes fall in value. Biggest drop since the Great Recession. Yikes. Home values are falling far more than half of America. The biggest share since the country was still clawing its way out of the Great Recession. New data from Zillow shows 53% of U.S. homes have lost value over the past year, the highest level since 2012 when the housing crash finally hit bottom. Prices have been slipping in much of the South and the West as more homes hit the market and buyers stay on the sidelines. Many of the biggest drops are in once red-hot pandemic boom towns. In Denver, 91% of homes have fallen from their peak value. 91%, yikes. 89% in Austin, 88% in Sacramento. Florida has been hit hard too, statewide. More than 80% of homes in Jacksonville, Orlando, and Tampa are now worth less than they were a year ago. Dallas and San Antonio also seeing declines of more than 85%. So we've got California, we've got Colorado, and then we've got the Sun Belt seeing the worst sell-offs. More than half of homes are losing value, and not a moment too soon. This needs to happen because look at this garbage. Just look at what we have done to our kids. And by our kids, I mean our young adults. The average first-time home buyer is now 40 years old. Your life is half over before you get your first house. What the hell have we done? This has to change. We need lower home prices. We don't need 50-year mortgages. We don't need more cockamamie forbearance plans and loan workouts and the FHA and create an acronym for some bullshit. Let the prices fall, and they will. Guys, you wonder why there's Gen Z riots all over the freaking world? You think maybe it has to do with the fact that we have stolen any hopes of a better future in the name of endlessly inflating asset prices? See also this parade of Fed bulls trying to blow air into the AI bubble today. This is gross. I'm not even going to read the rest of this article because it's all about like, oh, here's ways you can buy sooner. Like, here's all these ways you can go up to your eyeballs in debt in order to support these higher home prices. 40 years old, first-time home buyer. Cancel that noise. That's just dreadful. So shout out to anybody who guessed 40 in the poll there. That's terrible. Half of first-time home buyers are older than 40. No, thank you. Meanwhile, 401k hardship withdrawals more than double as people raid their retirement savings for emergencies. You think maybe the cost of living crisis that has driven homes to those unaffordable levels might be contributing to 401k hardship withdrawals, you think? You know what else is contributing to this doubling of 401k hardship withdrawals? How about this one? Amazon cut thousands of engineers in its record layoffs, despite saying it needs to innovate faster. How are you going to innovate without engineers? Oh, the customer service people going to innovate? Nope. You laid them off too. Maybe the guys in the warehouse are going to innovate? Nope. We all know what they're going to do. They're going to say some shit about AI, and then they're going to replace those American engineers with new hires in India. That's what they're going to do. Exactly what Amanda Goodall, a.k.a. the job chick, said on my interview with her last week. Shout out to Amanda. Excellent call. She said engineering was what they were cutting off. And look, when you look at the actions versus the words, if you're cutting engineers, what's the plan for your CapEx spending really going to be? Gotta love it. Meanwhile, Trump signs an order to remove tariffs from Brazilian beef and coffee. Now, this is pretty interesting because he said these tariffs were all about the political prosecutions of the prior Prime Minister Bolsonaro. Well, they're still prosecuting him. So he's getting rid of the tariffs and getting nothing for it. That is a surrender because he got his clock cleaned in the elections, in the statewide elections, and he needs to lower prices. They are taking the affordability crisis seriously. And by the way, if you're taking the affordability crisis seriously by rolling back the tariffs, stop telling people tariffs don't raise prices because your actions say otherwise. But here's an interesting thing about this rollback of tariffs on coffee and beef. The order will affect Brazilian imports to the U.S. on or after November 13th and may require a refund of the duties collected on those goods while the tariffs were still being charged, according to the text of the order released by the White House. Tariff refunds as part of this rollback. That's kind of a weird, almost dangerous precedent that we're saying, okay, when we get rid of tariffs, we refund the prior ones. What happens if the Supreme Court strikes down the tariffs then? Are we talking about tariff refunds? And where is the government if they're helicoptering all this money to buy shares in Intel and give people $2,000 rebates? If the Supreme Court strikes down the tariffs, are they going to have to go to the bond market to get the money they need to pay people back from the tariffs? And what the hell is that going to do to liquidity? So they're making a mess here with this one. Interesting story here. Look, I'm generally supportive of the effort to reshore manufacturing. I think we need a real economy instead of an economy that exports only Ponzi schemes and inflation. But we went about this so clumsily and so haphazardly that you just knew they were going to break something. Meanwhile, private credit defaults expected to drive 2026 stress, UBS says. Not too big of a surprise here, but there is some stuff. They're saying we think a 3% rise in defaults and private credit, probably going to be higher than that. Private credit is a mess, but it's down towards the bottom here. Look at all the overlaps with AI here. UBS also said the private credit is particularly concentrated in certain vulnerable sectors, including ones tied to artificial intelligence, which can be catalysts for elevated defaults. To be sure, the bank expects defaults to stabilize by late 2026. Oh, it's almost like it's an isolated event and it's contained. AI presents a double-edged sword for private credit. According to UBS, if there's a downturn in AI, as many as 30% of newer firms with private credit could be impaired. Conversely, if AI drives widespread enterprise disruption, as much as 40% of private credit's assets may take a hit. In other words, they're properly hedged so that they lose money no matter what happens. All right, good work, private credit industry. But you'll be relieved to learn that private credit now accounts for 11% of gross domestic product and is increasingly tied to the banking and insurance system. Oh, joy, UBS said in their report, meaning the asset class will largely influence the outlook for overall credit markets next year. Banks with assets over $10 billion now have more than $2.2 trillion of exposure to loans to non-bank financial institutions, a figure that's expected to keep rising. Those numbers are mind-boggling. 11% of GDP. Holy shit. $2.2 trillion of exposure to NBFIs, non-bank financial institutions. Understand, guys, banks are not allowed to lend to these risky companies, but banks are allowed to lend to the hedge funds and the private equity firms and the private credit firms that are taking that money from them and then lending to those companies that the banks aren't allowed to lend to. In other words, banks are just using middlemen to do the same stupid shit that caused the global financial crisis. $2.2 trillion. When this AI bubble blows, it's going to take banks down with it. Oh, good. So we got that going for us, which is nice. Hey, I just want to say thank you very much to Mr. Hunt and Cover. Says Jensen, Elon, Arab moderator, asked Jensen if there's a bubble. Jensen's political non-answer wasn't the answer investors were looking to hear. What's your take? My take is Jensen Huang is lying if his mouth is moving. I didn't see that particular talking point, but I did mention in my video yesterday about the market calling bullshit on NVIDIA's earnings that the one thing that could possibly keep this bubble inflated, or dare I say inflated further, is sovereign data centers being built by these Arab countries like Saudi Arabia and the UAE. Jensen and Elon are all out there begging for cash from these countries to build data centers. There's no struggling U.S. power grid to worry about there. They have all the oil in the world they could burn to power them there. And President Trump appears to be nudging them in that direction, using things like tariffs, trade deals, and F-35s to encourage them to invest money in U.S. chips. So it looks like that is the new preferred method because the government bailout in the States didn't work. Private credit's not going to work. So maybe the Saudis will be able to do it. So yeah, burning oil to keep the AI bubble inflated from the same people who told us to eat bugs 2 years ago. That's nice. Thank you, Hunt and Cover, for supporting the channel, sir. Madison Hypes says, where's the Big Short movie about Jackson Vidya put? I demand to be portrayed by Alan Tudyk. No reason. He doesn't look like me. The guy just cracks me up. I think he is hilarious. I am a leaf on the wind. Thank you very much, Madison Hypes. Don't threaten me with a good time. Ed MB 9 Feet says, some insurance companies suggested to have 30% of their capital portfolios in private credit. You think maybe those are the insurance companies that were just bought by private credit firms that need those insurance companies to buy their debt offerings with other people's money? Maybe that has something to do with it. Likely the reason for increasing premiums and expect those to continue. What could possibly go wrong? Yes. Do we need to put this on? What could possibly go wrong with private credit and what it's doing to insurance? When insurance companies start to go bad, like remember AIG was the biggest part of the collapse outside of Lehman Brothers. AIG was the biggest firm to go bust during the GFC. And the government stepped right in with the bailout when that happened. So They're not going to bail out the AI bubble, but they may bail out the private credit firms that lose money because of the AI bubble. That is feasible. Thank you, Ed, for supporting the channel, sir. You gotta be kidding. Now, yeah, I ain't kidding, brother. You gotta be kidding. Says buy dips on metals or wait for short covering. Look, I don't try to time markets with metals. I treat metals like a savings account, not like a trade. So I make regular buys all the time. I do think this price slam at options expiration that Bob Coleman is talking about is worth keeping an eye on. It appears to be accurate. I haven't really had time. It's been such a busy week. I haven't had time to really scrutinize what Bob is talking about. But if he's right, that means these price smashes being created by options expirations in SLV are buying opportunities that will quickly rebound after that options expiration. So again, that's not what I'm doing. I'm not trying to time that trade right now. I just nibble on metal on the regular. But thank you very much. You got to be kidding me for supporting the channel. T.A. Chapman, thank you, sir. Says, happy Friday, Jack. Like and sub Melon Minions. I'm Jack Gamble, and I approve this message. You had the interview about bond bear market. It had me thinking about interest rates with housing crash, price and interest rate sweet spot, plus or minus a few years. Hey, let's look at what happened in the early 80s to the real estate market, all right? Home prices did take a dive, but interest rates, mortgage rates went like double digits. So not exactly easier to get a home. I would say far more important to make sure your credit is solid and far more important to have cash on the sidelines for a down payment if that's really where we're going into this bond bear market with decades of higher interest rates, which are needed. All right, this Ponzi economy, this endless Zerpenberg pump of asset prices resulting in zombie companies, it's got to end. It's not good for anyone but the upper echelons of society. Everybody else is paying the price for it. Thank you, T.A. Chapman, for supporting the channel. Oh, he's back again with 20 Nobody Special Finance memberships gifted. Thank you so much, T.A., for the support of the channel. I really appreciate that. Welcome to the Melon Patch, you 20 new melon heads. You be sure and say thank you to T.A. in the comments. That was very generous of you, sir. I appreciate that very much. Hey, Steve Woitis says New York Fed President Jay Williams recently met with market participants, banks, to address higher than normal rates in the repo market. Thoughts? All right, so the repo market, we did see, especially at the end of October, we saw an uptick in usage in the repo market. It coincided with the reverse repo getting to near zero. We also saw things like use of the Fed's discount window stepped up a little bit. So we are in the very early innings of a liquidity problem. And if you look at the sell-off in tech, and if you look at the sell-off in Bitcoin, that really intensified right around that same time, I think there's some truth to that. I think liquidity, it's not yet a 4-alarm fire, but we're getting there. And the fact that the New York Fed met on Friday with the banks in the, after Friday afternoon news dump to just remind everybody, hey, the Fed repo window's here if you need liquidity, and it's okay if you need a lot of liquidity. That's not a good sign, all right? Like, hey, it's just a reminder, guys, we've got fire alarms in every room, even as we smell smoke. Maybe there's something going on there, but not a crisis yet, Steve. We are getting there, but it's not a 4-alarm fire yet. Thank you, sir. Good comment. M&J, thank you so much for everything you do for the channel. M&J says, viral X post, baby. Congrats, you earned it. Talking about my post about accounts receivable at NVIDIA. By my last check, 3.1 million views on that one. There's people posting about how a few hours after NVIDIA earnings, Wall Street algorithms spotted red flags in NVIDIA's earnings with a big jump in accounts receivable. Yeah, Wall Street algorithms. You spelled my name wrong. Yeah, your Wall Street algorithm spotted it after you fed it my Twitter feed. Yeah, then they spotted it. Yep, that post went viral, and for good reason. NVIDIA, they're full of it, and the market called bullshit on those earnings. Thank you so much, M&J. Appreciate the super chat. Uncle Fedster says, happy Friday, Jack. Great work on the additional content. And thank you so much, Uncle Fedster. Yeah, we took some time to dunk on the NVIDIA bulls a little bit yesterday. I had some fun with that one, reading the mean tweets. I took a page out of, was that Jimmy Fallon show where they do that? I had some fun with that. Check out that video about NVIDIA's earnings that I put up yesterday. Thank you so much, Uncle Fedster, for the support of the channel. Meow Meow 8873 says, I made a comment on a TikTok video that a certain Chinese leader that may or may not resemble a certain Pooh Bear was incapable of pleasing a woman due to size issues. There's a bill for that. And now I'm blocked for life. Should I avoid any trips to China? Well, I won't be making any trips to China anytime soon. And all I can say is, God Emperor Xi, it happens to a lot of guys. And there's a pill, there's a pump, there's hardware, there's surgery for just about anything these days. So I wish you luck. And while we're on that subject, I would just like to say welcome to all the China bots once again, you adorable little government operatives, you in my comments. Thank you so much for the engagement. You guys are just so cute. Thanks, Meow Meow, for supporting the channel. Harmon Air LLC says, Jack, easy on the doom. No can do, Harmon Air. Written right here on my arm in invisible ink. It says Perma Bear. It says Doomer. Sorry, man. Moderation waved bye-bye to this channel a long time ago. Not to be confused with my moderators who do an excellent job in the chat, by the way. Thank you guys for everything you do for the channel. Hey, thanks, Harmon Air, for supporting the channel. Chuck G says, I'm 39, never owned a Hoke before. Is that never owned a Virginia Tech mascot, or is that a misspell of a home? But I digress. I make six figures, and I refuse to spend 50% of my income on a mortgage. Homes shouldn't be a retirement fund. Well, I can tell you right now, Charles, the cost to rent is cheaper than the cost to own by one of the widest margins we've ever seen in this country. So as much as some people are going to read that comment and probably make some kind of like snide remark about it doesn't own a home, must be broke, you're winning on a monthly expense basis right now because the cost to buy, maintain, pay the mortgage, property taxes, all that crap, you've got a couple of $100 a month left over afterwards because of what you're renting. And, well, if some of that finds its way into something like the shiny, well, then you're winning on both ends, aren't you? Thank you very much, Charles. I agree with the sentiment there, although I do own a home right now. I bought in 2018, bought way too much house, as so many people do. It would be cheaper to rent than to own. Steve Canyon 38 says, why do we get half of our beef from Brazil? Because we treat our cattle ranchers like the cattle that they raise. We abuse the hell out of our ranchers, combined with a drought in the earlier part of this decade. The bottleneck at the meatpacking plants in response to COVID they basically had to eat their seed corn. The U.S. herd shrank to an all-time low. And go figure, when you have a smaller cattle herd, supply gets smaller, price goes up. It's funny how that works. We abuse the hell out of our cattle ranchers. Combine that with all the BS we put them through with the Bureau of Land Management and the grazing fees we charge them for grass nobody's using anyway. So stupid. That's why we end up buying our beef from Brazil, because we beat the hell out of our ranchers and they didn't deserve it. So it sucks. It really does. And now we're rolling back tariffs on Brazil, subsidizing beef in Argentina. Now, treat farmers like a problem and you won't have any problems to deal with anymore. And then you can wonder why it's so expensive to eat. Thank you, Steve, for supporting the channel. Armando Reyes. Hey, Armando. He says, Trump still has 3 more years. We're in for a wild ride. The midterms should be very interesting, especially if the military stops following orders. All right. The whole thing about like the doomers and like moderating. All right. That we're going to moderate a little bit. I don't think we're anywhere near the military stop following orders. I don't think anything like that's going to happen. I do think we're in for a wild ride in the midterms. I think you can expect nothing to happen in Congress other than stupid speeches for most of next year, maybe more political brinksmanship and things like that. But don't expect any big like economy saving legislation. It just ain't going to happen, not within an election year. And interestingly enough, Alexandra Ocasio-Cortez was making a speech all about quoting that MIT 95% of AI companies are losing money story, or 95% of companies using AI money or seeing no return on it. AOC agreeing with Jack about AI. Hey, I don't know who had that on their 2020s bingo. What the hell? AOC, I find myself on the same side of an issue as a New York City socialist. Jeez. Hey, you think she's seeing anyone? Asking for a comrade. Anyway, guys, AI is going to be a campaign issue. Trump will regret attaching himself at the hip to AI and crypto. Thanks again, Armando, for supporting the channel. And Chris the First, or Chris, says, Jack Pitts versus NVIDIA. Go home, Andy. Get your effing shine box. And get your shine box. Yeah, that's Goodfellas, right? F you, pay me. Oh, your credit default swaps are trading at 700 basis points and you got delays in your data centers. F you, pay me. Oh, you reported $300 billion in remaining performance obligations and your stock is down anyway? F you, pay me. I don't care about this. I really don't care. Let this bubble burst before it gets worse. It's already too late for most people, guys. Thanks again, Chris. Armando's back, says, I don't want to prolong the house of cards from tumbling down. I say we roll out the red carpet, let her happen. Look, the sooner the better on this bubble bursting, all right? It's not going to be good. And, I have to keep that in mind as I'm rounding third base and everything, like hooting and hollering when NVIDIA stock goes down. Keep in mind what this means. Everybody is invested in this bubble, whether they realize it or not, which means everybody's going to lose money when this happens. And they're all going to wonder what the hell happened. And I've been trying to warn them for 2 years, but the press said, don't listen to me. And they just kept pumping this bubble and pumping this bubble. But guys, this is going to get really, really painful for a lot of people. All right. Understand, $20 trillion bubbles don't painlessly, slowly deflate. It's going to be violent and it's going to be brutal. Thank you, Armando, for supporting the channel. Hey, there he is back again with the popcorn and the party sound to go with the violence and the brutality, all that stuff. I guess something of a contradiction there. Thanks, Armando. Appreciate the support. Hey, Billingtano. Thank you so much, Billingtano, for supporting the channel. A new YouTube member. Welcome to the Melonheads. By the way, guys, new members, you get a free super chat every month. Feel free to use that. I'll read and respond to your questions live on the air. Thanks again, Billingtano, for supporting the channel. Charles G is back again, says, don't forget about that giant fire in Texas that affected a lot of cattle ranchers. That's right, drought and fire. The two tend to go hand in hand, by the way. My rent is cheap. I'm paying off debt. Yep, good. Get out of debt. Save that money. You're doing it right, Charles. And good call on the fire, also adding to the pain of our ranchers. Again, they need a break. We stop abusing farmers. Stop treating farmers like stupid, ignorant rubes who need to just shut up and grow our crops and keep the people in the city fat, dumb, and happy. All right? Keep abusing them, and you won't have any farmers, and good luck with that. Thank you very much, Charles. I appreciate the super chat, sir. By the way, farming is incredibly difficult, all right? If you got laid off from your software job and you're like, oh, well, I'll try farming, have fun with that. Good luck. Trust me, I've killed enough tomato plants to know I got no business being a farmer. None whatsoever. Hey, everybody, thank you so much for having your coffee with the Melonheads this morning. Don't forget that like button and that subscribe button for the YouTube algorithm. Thank you so much for all the super chats and the generous support of the channel, especially you guys, my magnanimous Melonhead members on YouTube, Patreon, and Buy Me a Coffee. Thank you guys for everything you do. Links down below should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Everybody, till next time. Live small and dream big.